Purchasing dividend-paying assets is an excellent approach for investors to achieve a consistent return. However, there is more to it than simply picking a high-yielding stock or fund and profiting handsomely. If you buy an asset just for the high yield, you risk losing most or all of your investment. There's more you should know about dividend investing that can help you reduce risk while also generating consistent income and long-term generational wealth. These are the 12 most important aspects that all investors should be aware of. Keep an ear out for number 1, which might help you earn hundreds of thousands of dollars more. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. Dividends are a key component of overall returns. Dividends have accounted for more than 40% of the total returns of the S&P 500 over many decades. The relationship between dividends and capital gains hasn't been stable year to year, but they do operate together over time to deliver a combination of growth and income. Capital gains account for a far bigger percentage of returns during bull markets when prices are high, whereas dividends account for a larger percentage of returns during bear markets when prices are low. Using both types of income can assist produce a more balanced portfolio during all market cycles. Number 11. They have different frequencies. Dividends are typically paid quarterly, every 3 months, whether from an ETF or single stock. However, firms pay dividends on a variety of schedules. Monthly dividend-paying stocks like Realty Income and AGNC, as well as ETFs like SPHD, are popular for their monthly income, which can make it easier to budget for consumers who rely on regular payments. Monthly payments are also advantageous because you do not have to wait for them, and they may be reinvested much more quickly. In contrast, a firm like Disney only pays out dividends twice a year. Number 10. Dividends are taxed differently than interest. We are all aware that there are numerous moving pieces when it comes to taxation. Various employment, investments, accounts, and seemingly everything is taxed differently, and dividends are no exception. Dividend income may be completely tax-free depending on your annual income and tax rate. Single taxpayers with taxable income of $40,400 or less, for example, will pay no tax on qualifying dividends, even if the investments are held in a taxable brokerage account. Due to the complexities of taxation, it is recommended that you contact with a CPA. Number 9. High payout percentages are a warning sign. Dividends are provided to shareholders to share a percentage of a company's success. That was at least their first goal. Individual stockholders should keep a close eye on the payout ratio. Aside from other important financial aspects, the payout ratio is simply the amount of money paid to shareholders in relation to the company's profit. The payout ratio is 70% if the company's average earnings per share are $10 and the annual dividend is $7. Various experts advise investors to remain with stocks with low payout ratios, such as 50% or less. Companies normally aim to maintain consistent and rising dividends, but if earnings aren't rising in tandem, this could lead to a rising payout ratio and signal a larger problem. The power of reinvestment is number 8. When frequent dividend payments arrive in your account, it may appear that the money is available for spending. The truth is that reinvesting dividends is where the actual growth will come from. Assume you buy 100 shares of a stock that is trading at $100 a share. The company pays a 5% dividend at the time of purchase, and both the share price and dividend yield are predicted to grow at a 5% yearly rate. If you had not reinvested the dividends, your initial $10,000 investment would have increased to $59,000 after 25 years. If you had reinvested the dividends, it would have increased to $115,000 instead. Consider this example, the S&P 500's dividend reinvestment power. Aristocrats and kings provide stability. A dividend aristocrat or dividend king is an S&P 500 firm that meets certain criteria for a long history of dividend payments. A corporation must pay a dividend and grow its payout annually for 25 years to become a dividend aristocrat. A dividend king is a corporation that has regularly paid and increased its dividend for the past 50 years. These stocks provide stability because the companies are anticipated to continue distributing profits in the future. This isn't always the case, as AT&T recently shown. AT&T maintained a 36-year streak of dividend growth before reducing payments in 2023. If you choose, you can buy an ETF made entirely of aristocrats or kings. 6. Dividends can be reduced. It's vital to remember that dividends are a product of earnings, and if a company's earnings fall, chances are its payout will follow suit. After many years of stability, numerous companies, including Kodak, JCPenney, and Radio Shack, discontinued paying dividends. When corporations are in good health and have strong balance sheets, the likelihood of a dividend increase is high. Companies do collapse, however, and it is vital to be cautious of this by carefully considering its profitability. Fortunately, by conducting research and paying attention to the writing on the wall, investors can avoid this type of loss. Number 5. Certain industries give higher dividends. The fundamental reason some industries paid bigger dividends than others is consistent earnings. Telecommunications, utilities, and consumer staples are considered secure investments that can earn money in practically any market, since consumers aren't going to turn off their lights, stop using the internet, or stop buying toilet paper. They will, however, quit taking vacations and spending money on frivolities. Sticking to these more solid industries can boost your chances of earning consistent income. However, relying on a sector for stability is not foolproof. Prior to the 2008 housing crisis, banks were also seen as fairly trustworthy dividend providers. Number 4. REITs provide large dividends at a significant risk. Because of their tax structure, real estate investment trusts pay some of the highest yields in the stock market. They are expected to distribute the majority of their profits to shareholders in the form of dividends. This is excellent for dividend returns, but these investments might be risky. While you may believe that real estate is a safe investment, many of the businesses held by these real estate organizations are extremely vulnerable to the economy. These include retail establishments, shopping malls, and office buildings, all of which suffer greatly when the economy falters. Furthermore, these corporations make a lot of money off of debt, so a drop in income might be disastrous. Number 3. Quality dividend stocks provide more than just high yields. The key to dividend investing prosperity is more than simply purchasing a stock or fund that delivers a high yield. When evaluating dividend stocks, a number of aspects should be evaluated, including profits and sales history, corporate debt, dividend reliability, and dividend growth, among others. Keep an eye on these data on a regular basis to ensure you're not clinging to a dying company, and always pay heed to the writing on the wall. Number 2. Dividends were once more important. Investors used to be primarily concerned with dividends and rarely considered capital appreciation. Prior to the Great Depression, stocks were supposed to yield more than bonds to compensate for their higher risk. To put this in context, bond yields in the 1920s ranged between 4 and 6%. Capital appreciation was still acknowledged, but it was mainly regarded as speculative. Number 1. Dividends may result in slower development. The fact that a security pays a dividend does not imply that it is free money. In general, a corporation will not pay a dividend if it can reinvest the money and gain a substantial return. They distribute gains to shareholders when they determine that they cannot properly invest all of their profits for the returns they were previously able to get. Some investors interpret the beginning of dividend payments by a corporation as a sign of decreasing growth. Simply said, dividends frequently, but not always, result in reduced total returns, since the corporation no longer has the flexibility to make the highly profitable investments that it once did. This is why dividends are paid by older, slower-growing corporations such as IBM and Coca-Cola. Growth equities have generally provided stronger long-term returns. Choosing the appropriate option for your portfolio might be the difference between hundreds of thousands of dollars and more. For good reason, dividend-paying investments are popular. Remember that there is no such thing as a free lunch, and every method has advantages and disadvantages. If you are presently investing in dividend stocks or are thinking about doing so, keep these key considerations in mind to optimize your potential gains. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?